We saw almost $1 billion investment in 2021 in the lending fintechs in India. And with that, the kind of market that we're expecting to serve in next few years is going to cross over $500 billion. And that's going to happen at a scorching pace of 33% CAGR. And that's the kind of impact lending fintechs are making today. And not to say just lending fintechs, but digital lending overall, because banks, NBFCs, everyone is part of that ecosystem today. And these are being driven by both supply side as well as demand side drivers. And we know enough about it, but let me just summarize. On the demand side, India is seeing a huge middle class population with almost 46% households in that segment. And quite a few of them are in the urban segment as well. And in terms of internet consumer base, that number is again growing. We are already crossing 600 million internet users, and this number is going to touch over 900 million users in 2025. So all of these factors are really driving the way lending happens in the country and the lives of millions of consumers and businesses. So during the session today, with this eclectic mix of fintech thought leaders and achievers in their own aspects, we'll try to delve more into what is the kind of impact digital lending is creating in India, what it is expected to do, and how we are managing risks in lending. So with that, let me start first with Bhavin. P2P lending was one of the flag bearers on lending front, but somewhere it kind of slowed down. But we still believe with a population like ours, the potential is huge. So Bhavin, what is your perspective on P2P lending? What kind of potential do you see? What kind of impact do you see P2P lending making?
So you are right, Parijat, when you said that it slowed down from the initial enthusiastic start. So if you look at the initial starting period of P2P, that was between 2014 to 15, and it took around three and a half years to reach 1,000 crore worth of disbursement across all the platforms. But if you look at the growth between 2019 till now, last three and a half years, it has grown from 1,000 crore overall disbursement till 15,000 crore overall disbursement. If we look at the current annual run rate of P2P lending platforms in terms of disbursement rate, it is somewhere around 2.5 billion. And I believe by, so there were many projections by international agencies that the Indian P2P market will reach 10 billion plus in 2025. But I am happy to share with all of you guys that we will reach that 2 years before that target.
Wow.
So that's the potential, and I believe the innovation, the way India is working towards making finance differentiated compared to the other global counterparts like US, Europe or China, I believe P2P lending is going to be one of the most prominent future of Indian lending.
That's great. Like, so we're going to see almost 5x growth in next 2-3 years. That's
Absolutely.
a fantastic number. So over to Deepak. We have seen with GST coming in, MSMEs, a lot of data has got digitized, and that has propelled digital lending in MSMEs. So what's the kind of impact that you're seeing for SMEs in particular, and maybe also looking at supply chain financing, because FlexiLoans is also leading the front for supply chain finance?
So, thanks, Parijat. So, in last few years, government has done a lot of initiatives, starting with JAM, Trinity initiatives, and now with GST and account aggregator. We're seeing a lot more formalization happening on the economic front. So, if you look at the MSME ecosystem in the country, almost 50 million MSMEs are kind of unserved or underserved. Of the 65 million SMEs, which we think is a serviceable market.
That's a huge number.
That's a massive number. And if you look at this market, which is sub 20 lakh rupees of ticket size loans, almost $50 billion market is touched by the informal economy and not by the formal economy. So if you have to bring them into the formal economy, it's a massive market out there to be served, and that's the problem many of the fintechs we're trying to solve here. With initiatives like GST or account aggregator, this will become even faster for us to use technology and give them solutions to these MSMEs, because when these MSMEs want loan, they want in 24 to 48 hours, and that's where they use either a loan against gold or an informal channel of borrowing. So with more data coming to us in faster methods, and our ability to recollect that through various initiatives NPCI and others are taking, I think the formalization will happen even faster and faster. Another great thing which is happening beyond GST is the trails which UPI and other payment ecosystems are creating. So what's happening is you can tie up with a lot of payments aggregator, and with the customer's consent you can look at their payments behavior and go out and lend to them as well. So that's third major piece. And the third is the supply chain, which again most of the banks and NBFCs, they solve the tier 1 supply chain for large corporates. The long tail of distributors or vendors were not really clearly attacked or solved by this larger NBFCs. That's where a lot of fintechs like us are operating. Just to throw some numbers, in last few years, we have given loans to almost 100,000 MSMEs, pan India, almost in 3,000 locations. 50% of the loans we give are in tier 2, in fact 60% of the loans we give are in tier 2, tier 3 towns. So it's the real impact which is happening in the smaller towns and cities as well. Our average ticket sizes are in the range of 3 to 4 lakhs. So again, it's the smaller ticket size and faster ticket loans which keep happening a lot.
Sure. So huge impact in tier 2, tier 3. And with that, my next question is to Rajesh, because you operate in gold loans, and recent RBI report said that the penetration for digital lending is under 1% for gold loans. So how do you see that opportunity in gold loans, especially since it's collateral based? And do you see more demands in tier 2, tier 3, like what Deepak mentioned?
Thanks. Yeah, if you look at the focus area for us also has been tier 3 for two reasons. One, the largest gold holding also is in tier 3 in the rural, if you look at. It's not in tier 1 and 2. And this is the market that is underserved. And it's not that they have no access to gold loan, but they all have been going to money lenders, pawnbrokers, and in the recent years to NBFCs, because NBFCs have brought in the comfort, convenience, and the TAT. But it is coming at a cost, which the consumers have been realizing now, that they can shift or make an attempt to go to a bank, where again they have their own constraints in terms of being first-time borrowers, or they have their own constraints in terms of thinking that whether bank will give me a loan. That's the role that we have been playing. So we see a huge opportunity. Just to give you numbers, only tier 3 market is close to about 20,000 crore loans per month from an overall potential, versus almost about 15 to 16,000 crore coming from tier 1 and 2. And that's where our focus is. We have been serving tier 1, 2 also, but majority of the business is coming from tier 3. We see this is going to grow hugely.
So coming to Sanjay, now banks obviously have been creating digital journeys all across, and the technology innovation though started with fintechs, but especially private banks have caught up really well and are leading innovations themselves on this front. So what is your take from a banker's lens in terms of how this landscape is evolving? What do you see? How is the bank reacting to this situation?
Yeah, thanks, Parijat. In fact, I think banks have a lot to learn from what's happening around the ecosystem. I think banks were late starters. I think the entire payment wave taught banks that they cannot be caught napping. And I think banks have learned, and I would split the learnings broadly into about 3 categories. One is on the customer side, one is on the infra side, and on the tech and analytics side. On the customer side, very clearly, the fintechs brought in a lot of superior journeys and ease, which was a learning banks processes and mechanisms, probably at times a little more clunky, couple of more checks needed. The second thing is, of course, newer segments of customers, could be new to credit, newer geographies. And the third, obviously, was what we keep now calling small ticket, small tenor loans. Banks are always averse to those type of loans. I think from the customer side, banks picked up a lot of these things from what's happening around the ecosystem. On the infra side, very clearly, the ability to scale without necessarily having a large physical infrastructure was as a learning there. And obviously, banks generally have had a very people-heavy, paper-heavy model. Not necessarily the leanest and cleanest there. And I think those are learnings which we have picked up with what's happening around. And on the tech and analytics part, again, the amount of various AI models which are there with fintechs to be able to take faster decisions. Fintechs generally are more agile in terms of technology changes and adapting to them. And of course, working on tech-based credit models to reduce the cost of underwriting. So I think what all these things happening around the ecosystem, banks have always been doing some of this, but I think they're doing it a little more efficiently now. And I think it's good for the industry. So I think a lot of learnings from the fintech side, but banks are using their own learnings now to put this in place in a much more probably cohesive manner.
Certainly, I think good for the industry, certainly. You touch upon AI, ML, data analytics. So question for Anil is that since you're an unsecured loan, and that's where the biggest headway has been for lending, underwriting is the key. And we keep hearing that we move to completely AI, ML-based underwriting. What's your take on it? How much is it true? What is really the secret sauce that's behind the scene?
Yeah. In terms of underwriting, I think the principles have always remained the same, right? Like the more we've changed in terms of technology, the principles of underwritings have always been the same. Your first base is to eliminate fraud. Second is to make sure there is an intent to repay. Third is to ensure there is an ability to repay. And fourth, people don't say it aloud. You want to make sure there is your ability to collect on the loan, because that's the most important part, right? To give out money is easy, but to get it back is the difficult portion, and that differentiates any good lending businesses from the bad ones. So in terms of evolution, obviously, there used to be paper-based underwriting. There used to be intuition-based underwriting. Like our neighborhood kirana store fellow knew kisko kitna dena hai. Whether this guy needs a 1,000 rupee kata or this guy needs a 5,000 rupee kata, he knew it.
Relationship.
but the principle always remained the same. These are the four basic pillars on which they built the entire business. So as technologies evolve, everyone adopts it. I mean, I'll show my age now when I say the next statement. See, when OOPS and relationship RDBMS came, everyone adopted it. Today, to go back and say, I use an RDBMS, people will laugh at you, right? Like, everyone uses RDBMS. So just like that, if you say 5 years down the line, I'm using AML for underwriting, it's a laughable concept because everyone will have some level of AML in it. So technology is never is just a tool. It's how you use and how you interpret it, and make sure that while you are doing it, especially I come from a US lending background, that when you are using tools like that, that your monitoring and audit processes are strong, that there is no discriminative practices, and there is no disparate impact that your lending underwriting algorithms could bring. Those are the challenges for the future. But in terms of the principles, they will always remain the same. And we'll try to evolve using technology as a tool to just better deliver the service. What AIML or automated underwriting, whether it's rule-based, have done is you are able to now make a decision. What used to take 3 days to maybe 30 minutes can be done in a 30-second timeline. And especially for a company like ours, which is focused on the underserved consumers, and we are trying to make a loan decision. We give loans from as small as 500 rupees to maybe 2 lakhs. When you're, like Bhavin is in the same business, when we are trying to do a 15,000 rupee loan, 4 din to nahi le sakte, then your entire profitability is gone. So that the technology tools help you accelerate that decision, but still the principles remain the same, and monitoring and audit is the most important thing that people should focus when adopting these technologies.
Sure. So, one more question that comes to my mind for you is that with being physical, like completely paperless, completely faceless, there are situations where frauds can happen, and there were recent news about fake loans being booked in people's name where they were not even aware that their PAN card was being used. How does that really happen, and what kind of lenders do to protect that situation? Because it's also putting lender at with a bad name, as well as the portfolio can go really bad.
See, once more, fraud always exists, and you're trying to figure out various methodologies to do risk mitigation. The recent fraud we have observed mainly, which related to identity theft, is universal and affects everybody. But in terms of mitigating it, the best things are always what RBI mandates and everybody here follows is KYC, know your consumer. And as long as you do it very efficiently, especially when you're doing it digitally, you should not take any shortcuts. And sometimes, irrespective of how much safeguards you apply, it's not like traditional banks when they're doing paper loans with so much underwriting, it's not like they're not subject to fraud at all, right? Like all the newspaper headlines are about people have done fraudulent loans for thousands of crores and walked away. So when it happens at thousands of rupees, it's still fraud. And the same principles still apply. Like as long as your processes are strong, you have good know your customer policies. And especially when you're in digital, follow the rule book and the guidelines. Especially RBI now says do a video KYC. If you're adopting video KYC, do it two-way call. And there also, you just can't depend on the human that is interacting from your side, but also use technology as an overlying thing so that when they are showing their Aadhaar card or their PAN card, that you can actually use the data within that to real-time analyze it. And we use a lot of those tools. So, so while the fraud is a big problem, especially when it affects a retail consumer who never applied for a loan and now sees an inquiry in a bureau, it's traumatic for them. But I think it's a bit of an evolution and growth process for the space. And I'm sure all of us are trying to make sure that we want to mitigate it. As I said, the first basic fundamental thing everyone wants to do in underwriting is eliminate fraud. And that's, I don't think anyone takes it lightly. But it's still at the same time, fraud still happens.
So, Parijat, sorry, just to add on, see, it's good thing that in last 4 or 5 years, we have been talking about this issue. Just go 10 years back, or maybe 2008-9, when so many fake credit cards were issued on name of so many people. मतलब आपका bill आ जाएगा and then you will come to know that, okay, 1 lakh rupees is used, right? But people were not even discussing these points. Why? Because it was very difficult to identify fraud. Nobody was encouraging anyone to discuss about it. Today, after digital lending is coming into place, the identification of fraud has become much easier, much faster. Fraudulent activities have been always a reaction by any financial institution. But if we compare it with physical era and digital era, here it is much, much faster than the physical era. And I believe we have been more reactive to the situation, and very fast we close those windows which are being used by people.
So the reaction time has come down.
Absolutely.
Safeguards have improved, but still like fraudsters may be still finding a way out.
So it is like we talk about at a global level that from tomorrow there won't be any hacker in the world, which is ideal situation, but practically it is not. Anil, you want to say?
Just to add to what Bhavin said, like the customer who is digital has a pretty good digital footprint, right? Like, and the customers we deal with are very young. And the first thing they do is express themselves on the internet. Like if you're eating pani puri, they're telling the world that I'm eating pani puri now. So if I see a fake loan account created in I'm obviously going to tell in every platform. So the communication that is happening with the younger customer, with a large digital footprint is a lot more. So that gets a lot more currency in the media and everything else. It's just that Bhavin is very right. Like we get to know it a lot, and that is making us better. Like we are able to react, and now all of us are taking several proactive measures at an industry level to make sure that we can tackle this problem.
So taking the cue from reaction, so that there have been a lot of macroeconomic situations over the last 2-3 years which have tested both underwriting models and generally the lending itself. So question to Deepak is that how has the underwriting for SME been tested? Because there were models which were working well, but with COVID, everything went for a toss and there were situations. So how has been your journey? What have you seen?
So, if you look at this segment of small ticket loans, and if you study this for last 20-25 years, there have been a cycle generally every 3 to 5, 4 years in the MSME world or the consumer credit card world, etc. Now, in every bad cycle, if you go and talk to the bankers who've been doing these loans back then, or you look at data, you realize that the majority of the loans which went bad was the ability to trace that customer. So if the skip customer ratio is very high, you will lose those loans because there's absolutely no way to reach this customer, and thus your ability to collect does not exist. What we did, from the beginning when we started was we never lent to a location where we didn't have an ability to knock on the doors of that customer in real time. Less than 24 hours, can you go and knock on the doors of those customers, even if it's a remotest tier 3 town. So we get leads from roughly 6,000 locations pan-India. We give loans only in 3,000 because these 3,000 locations is where we have the ability to collect. Yeah, we are in business of giving money and not soaps, right? We need to collect back that loan. So thus you need to be very, very sure that you're collating enough data at the beginning to triangulate this customer and the location of this customer when the loan goes bad. So it also depends on what these two gentlemen were speaking, that how many different data sources you're tapping into while giving that loan or making that decision, and how are you using those data sources to triangulate that, okay, so we call it, the propensity to skip. So what's the propensity of these customers to become a skip customer? And there's a special scorecard only for that. Again, we dip into the bureau data, the data coming from various partner sources, the digital footprint, etc., to decide that, okay, what's the propensity of these customers to go skip for us. So those are the kind of things. For us specifically, in the times of COVID, fortunately, a lot of loans we did were online ecosystems. We are one of the largest ecosystem embedded financiers in the country. So, all the digital ecosystems is where we provide loans to SMEs. So all top e-commerce ecosystems, all payments ecosystems, etc. And thus, these were the customers who were doing, or the sellers who were doing really well, because the physical stores were off, but the online sales were happening. And thus, our collection track record was pretty well. In fact, our credit costs were one of the best in the industry, because of multiple reasons I spoke about.
Good to learn a few things from there. So, question for Sanjay. Now, when a bank works with fintech partners, and like you said in your opening remarks, that is critical of how to evolve and how do you see it moving forward, what do you look for in the partner? How do you really select a partner? How do you cover for risks for the bank when you actually engage with a partner?
Yeah, so I think banks are pretty clear that we need to work with partners. I think that theory that we can do things ourselves is out of the window. And we at Kotak also keep sort of looking at partnerships to work on. So what do we look for in a partner? We look at, when we are trying to work with partners, we look at partners who can probably bring a much superior customer experience layer, because that's something which banks lack, or I think banks have scope to improve. So clearly customer experience layer, ability to get into newer segments, which we have not really done much, but we would like to test. I think these are 2-3 elements which we look at when we look at a partner. But it seems to be working other way also. A lot of fintech partners are looking at working with banks now to understand the risk frameworks a little better. Some of the collection pieces a little better, because I think you shouldn't be lending if you can't collect. And lending is all about collections. It's not the other way around. And I think it's very easy to say I'll price for risk, but you can't keep pricing a product so high that you get only a portfolio profile which is not very great. So that's not a great business model. And thirdly, I think the fintechs also learn on various profitability metrics which banks look at, which eventually help them. I think that's been one of their challenges. So I think 2-3 things. We look at a fintech who has got a lot of clarity and focus on what they want to do, is able to bring in great customer journeys and ability to understand the customers better, which we can leverage on. And thirdly, who's clearly wanting to be on the right side of regulation. I think that's a strict no-no. Anybody who wants to play in the gray is out of the window. So I think these 3 things is what we look at in a fintech partner.
Sure, so we'll come to regulations in a short while. But a question for Rajesh is that, since you are in the gold business, there would be operational risk beyond the credit risk. We have been talking about credit and fraud risk, but in gold, operational risk takes surface. And you also work with quite a few partners yourself. So how do you really manage operational risk? Who owns the customer in this journey? Because there is bank involved and there's segregator model that you operate.
Yeah. In terms of ownership of the customer, we own the customer. SahiBandhu owns the customer. But then, as you said, this is a fully collateralized product. So, and RBI is very clear that 75% is the LTV. Most of the loans are 6 to 8 months tenure. So even if there is a default, bank is not going to lose money. From that aspect, there's no risk, but there's a risk that we carry in terms of assessing the gold at customer doorstep. That risk is carried by us. But it is, as Sanjay said, for us, we come from a legacy of a large group, which is 80-year-old. So commitment to the regulations and compliance is foremost. There's no compromise, shortcuts there. So winning the trust of the customer is very important. So in this product, you can't do everything digital. It is digitally enabled, tech enabled. We make the consumer experience, as Sanjay said, very, very smooth using our platform. But there has to be a physical interaction. So coming to what Deepak said, we have to meet customer in this product. We have to touch the gold. So there's nothing that we will do completely online. So from that aspect, we will know the customer very well. The entire customer's profile is with us. Background, we collect much more data than what the bank needs so that we know the customer better. We cover our risks fairly well. In terms of assessment, our people are trained, but then we rely on established players who have registered, empaneled assessors with them. And they commit in terms of if there is a mismatch with our valuation versus bank's valuation, they take a guarantee that they can pay back that money or they will buy the gold at the value. So that's the commitment that we have from the assessors. There are occasional risks in terms of the valuation mismatch, for which we do a fair coverage in our entire business plan, but that's very small, that's well covered. There's also a risk in terms of transferring the gold from customer's location to bank, which is a transit risk, which there could be intent of the person also. We don't outsource any of the work. We know our employees very well. But then we take adequate insurance coverage in terms of fidelity as well as transit. We've had very, very small cases of what we do is, even if we do at customer doorstep, just to give an example, we know at what time he has entered the customer place, and the entire proceedings there in terms of valuation, everything is recorded through our app, and that is available at the back end. So for a central operations team who do all the checks at the background that everything is fine. And then the money is transferred, and the moment they leave the customer's place to the nearest branch where the loan is likely to book, we know the transit time. So if there is a mismatch in terms of them not reaching, there are enough alarms, checks and balances at the back end. We've used technology to mitigate all this risk, but we feel we're fairly covered to take care of them.
So now flipping to the regulation, Sanjay touched upon that. So Sanjay, maybe the question for you itself. So everyone is talking about the new RBI regulations around digital lending. And so how do you see that kind of playing out? Of course, I think many of the panelists here are already with NBFCs, so fairly covered. But in general, how do you see the landscape evolving? What do you see the impacts of these regulations?
Yeah, no, I think the regulations or the guidelines were needed. I think it's important to have guardrails on what can be done or what cannot be done in the digital lending space. And I think the regulations that come out at least help provide the guardrails. And our own experience in the past is when you have regulations, they tend to bring in more transparency. And the transparency eventually leads to more trust from consumers. And the trust eventually goes back into growth. So I think it's a nice fine balance. You have the right regulations resulting in transparency, resulting in trust of customers, and then obviously resulting in growth. So I think we welcome the regulations, and I think it's good for fintechs too, from a more long-term perspective as they look at growth. And I think it's great for customers because generally the belief is what's good for customers is usually good for the industry too. And I think the regulations are good for customers, so it should help play out well.
Great. So maybe again, question to Rajesh, because now these regulations are talking about digital lending, and since you're doing gold on digital, how does that impact and what kind of alterations that you are seeing in your business model?
Yeah. So from beginning, our model was kept very flexible in terms of how the consumer journey, in terms of so customer acquisition is completely digital. That there is no change there. Customer onboarding also is being done through our platform. The only change that the regulation has brought is the disbursement of the loan has to happen directly by the bank to the end consumer. Even the repayment journey has to be directly. So for us, getting that customer was very, very important. The data points related to customer repayment as well as the disbursement is available as a batch file later from the back side that we get, which we can consume and analyze the customer behavior, everything. It need not necessarily flow through our system. For us, that owning that customer, that he should come to SahiBandhu. And what we have looked at is what is the need of the end consumer. Most of the targeted advertisement that you will see is for gold loan, you come to us. We have tried to go one step behind and see for what are they coming. So we have enough data in the last 3 years in terms of customer end use. That's where we have tried to target. And more and more we do this deeper analysis, then we have been able to expand. People who have not even thought that the gold loan could be an option, they have come to gold loan to meet that requirement. So our focus would be to meet that demand. We will follow, and we have tweaked immediately the model in terms of from the bank partners, the money can be directly disbursed to customer. We don't see any challenge in terms of our business model overall with the change.
So, Anil, I'm going to ask you to look into the crystal ball and talk about BNPL, which has been like really a talk of the town for quite a few years now. But globally, it has seen high NPAs. In India, again, we are looking at regulations coming in for BNPL. US is talking about regulations. How do you see that space evolving? Because it directly connects to your business as well of unsecured lending.
Yeah, I mean, BNPL has been a big growth factor, not just in India, but globally. I mean, the business model has been existing forever, right? Like buying products at the market price with a small discount from the merchant and trying to kind of adjust the pricing from the discount from the merchant as a means of managing credit risk. So the global phenomena has been mainly from 3 different aspects, right? Like one is the data protection issue itself. How much data is being accessed? How is it being accessed? Is the customer clearly getting informed about what is being accessed to underwrite the consumer? The second one is the overall pricing risk itself. Is the merchant aware of what they are getting into? Because there are several small merchants who are getting into the ambit of this BNPL products. And what the regulators are clearly concerned about from a consumer point about is the consumer sure about what they are getting into it. So obviously, during COVID, some of these companies have seen a lot of growth. And as especially in the US market, as the free money kind of left it, they are now seeing a bigger pressure in credit losses, which obviously is now trying to get passed on to the consumer. Because one of the biggest revenue earners for them is fee-based. They are charging really high late fees and all. So the disclosures is the challenge that everyone is trying to look at. But if you look at our own digital lending guidelines, it is pretty clear. Like the disclosures have to be transparent to the consumer. So, I mean, RBI has always been a very forward-looking regulator, and I think the digital lending regulations kind of speak to the BNPL product itself. The second thing RBI is trying to do, which is one of the biggest problems the industry faces, is most of them treat it as a payment product, hence don't do credit reporting. And when you don't do credit reporting, there are two risks, right? One of loan stacking where the customer is over leveraged. Two, the system, like lenders, other lenders do not even know the risk that they are about to carry because this particular credit transaction was not even reported as a credit transaction. And if you look at our digital lending guidelines, once more RBI is making clear, if you're giving money to a customer, whether whoever is paying for it, it is a lending transaction and has to be reported to a bureau. So once more, in terms of, I don't want to speak globally and several regulators are tackling it in many different ways. I think the digital lending guidelines that RBI has come up with have clearly laid out what they're expecting any credit product to do. And they have also laid out that BNPL is kind of a credit product. Stop treating it as a payment product and make sure that the disclosures are transparent and the reporting is universal. So, and they've also said most credit lending has to be done by regulated entity. Now, we used to call ourselves Fintech NBFC, and I used to come in a T-shirt. Now I'm putting a button-down shirt because I want to be first called as an NBFC that is using technology. So I think we as a country are better prepared to address these challenges than many regulators globally. And to Sanjay's point, regulation is always welcome, and if the consumer is protected, it's always better for the industry's growth.
Just to add, winning the trust of the customer is very, very important. As Sanjay said, if any RBI regulation is good for consumer, finally it is good for the industry. We've seen with the recent guidelines, there were few practices that were adopted where in terms of transparency, customers were not aware, especially in gold loan. That's how the industry operated overall from money lender to NBFC, something called jumping rate concept, high late fee charges. All those have been cleaned up now. For us, from beginning, we were very clear that we should have a very, very transparent way of explaining everything to customer. In the long run, we believe that's what is going to happen. So with this regulation now, it's a level playing field. Everybody has to follow the norm. So we believe it will weed out all the unfair practices, and it's a win-win for everyone, the bankers, for us, as well as the consumers.
And Bhavin, I didn't mean to put you on a spot by saying you're on a
No, that's absolutely okay.
Okay, so maybe just last two questions. So on crystal ball again for Deepak and Bhavin. Deepak, your question is, what do you see in terms of like BNPL, embedded financing for SME, since you're focused on SME financing? And Bhavin, for you, it's more on like, how do you see underwriting evolving? What kind of alternative data sources that you see could come in future for individual loans or consumer loans?
You want to go first, please? So again, the future is always where the customer's problems are solved. Yeah, and when you see the whole embedded finance as a concept, it emerged because, at the point of sale or when a transaction is happening, are you solving the need of credit at that point in time? And that's a real need at that point in time, right? And this is where the consumer BNPL is clicking as well. When a distributor is selling to a retailer, when a manufacturer is selling to a distributor, there's a real need of credit there at that point in time. And can you solve that in a journey which is embedded in real time? That's what Okin is trying to do as well. That's a massive problem out there. And I believe, if you were to look at next 5 years, supply chain as an industry or supply chain financing will grow massively. That's where FlexiLoans has invested a lot. We are already, lending with almost 20 plus ecosystems, and we have almost 20 lenders at the back end, who are doing this financing along with us, including all the top MNC banks, all the top private sector banks, etc., etc. So there are three types of products there: the vendor financing side, the dealer financing side, and the direct to retail or BNPL, the merchant financing side. In all of this, there is a real credit need which the fintechs are trying to solve by ensuring that the decisions happen real time. However, ensuring that you have done enough checks to ensure that the customer is real. Again, in this part of lending, there is a lot of partner data available because most of these merchants are buying or selling to this large anchor corporate or a large distributor for months and years. So you use that data, you use their KYC information to ensure that it's the real merchant who's applying, and then you also use the merchant sales ecosystem to triangulate the identity of this customer. With this, I think the embedded financing will go to the next level, and you'll see a few billions of dollars being disbursed. We at FlexiLoans are seeing massive growth in disbursement. So this is how the network effect happens, right? Initial years, you're collecting data, you're creating a distribution network, you're creating distribution touch points of sourcing, of liability side, et cetera, et cetera. In first 5 years of our operations, we cumulatively disbursed roughly $200 million. This year alone, we'll do more than $200 million. So that's the level of network effect, which keeps coming in as you scale and as you grow, and the right capital is backing you as well.
Fantastic. Bhavin.
So I'll not take much time, I am sure. They are worried about the time. So in short, I personally see a dream of India where you wake up in the morning, peeping into your mobile, and you see the message that today you may require 5,000 rupees to make this purchase for this plan. And that will be available by 12 o'clock in the afternoon. Go ahead and do that, right? So, and this is possible because data points are available. And I see that in next 2 to 5 years, Indian lenders will go too much deeper inside the data points. Not much on the personal identity side, but inside the usage pattern, behavioral pattern. So if I compare that simply with the physical world, which was going on for last 30 years, so there the bank manager would know the individual who is coming to take the loan, and he will do his own assessment, how they were assessing it. कि अच्छा पटेल साहब आएंगे, पटेल साहब ये करते हैं, इस तरीके से बिहेव करते हैं, कम्युनिटी में उनका इतना नाम है तो उनको 25 लाख का लोन दे सकते हैं. बट लेट्स से somebody else is there, उसको नहीं दे सकते क्योंकि ऐसा है. Now whether this kind of thing is possible by data or not, very much and in much depth, that okay, if Mr. Patel is taking this route to reach the office against Mr. Sinha who is taking the another path, and what is the difference between that and what could be the interpretation of these two differences of personality, right? So there are so many different things are possible. I have seen a couple of US startups, you might have seen as well, where doing underwriting basis on voice modulation of the customer, facial expression change from the video which they are submitting while completing the application, right? These are possible. Now point is how diligently you are working on those algorithms. I think in India till date we focus less on building the product or such kind of algorithm, whereas Europe and US focuses a lot on this, registering the IPs, creating patents around that. I believe now India has started taking action into this direction. So next 2 to 3 years we will see lot different kind of data points, even other than bureau or reporting which is happening in current world. But I think next 3 years will give you the picture, and we'll try to give us some visualization that how deeper lending can get into India.
Fantastic. So with that, I think we'll have to end the session here. We're already over time. But to just summarize, the lending itself is really underserved in India, credit as a product. And we see digital lending going to be the forerunner to make sure that that happens. Technology has enabled efficiency, brought in customer experience, made sure that the NPAs are under control. And the impact is still huge. By sitting in Mumbai, maybe organizations are able to serve in 3,000 plus locations. And what we are also hearing is regulation itself is not bad. That's bringing in more control, more transparency for consumers. And that drives trust, which will definitely bring in more network effect and more business for the industry itself, as well as benefit for the customers. So with that, huge round of applause for our audience and for our panelists who have shared their insights. So thank you very much, gentlemen. It was really a pleasure to have you here.
Thank you.